Okay, yeah. So now today we will understand about evaluating the various credit policy. What is the concept of evaluation of credit policy? In this, we will understand the what are the first thing we will see what is the benefit associated with giving the goods on credit. So credit sales, what are the benefits that we will see. Second thing is that cost associated with giving the goods on credit. Okay, so when benefit will exceed the cost, or when we will get the net benefit, a positive amount, then we will say that this policy is a good policy. So in basically credit evaluation questions, credit policy evaluation, present policy will be there, which will be followed by the organization. Then there will be proposed policies also. Okay, if company is wishing to change the credit policy, then we will have to see which policy is best and accordingly give our recommendation. So this is the credit evaluation. Here we will study the benefits associated with the credit and cost associated with the credit. Understood? If benefits exceed cost, then we will say that we will give the goods on credit. Before that, let us understand some terms. Last class we have understood this, no? Cash discount term 2 by 10 net 30 means what? Business will give you 30 days time to pay, but if you will pay in 10 days, you will get 2% discount. Okay, so two time limits are given. See, you can pay within 30 days, but if you pay within 10 days, we will give you 2% discount. Okay, so if you are able to pay within 10 days from sale, you will get 2% discount. After that, you will not get discount, so you can pay up to 30 days. So this is the cash discount, which is normally allowed to the customers to encourage them to pay promptly. Next is consignment sale. Everybody know what is a consignment. When a business sends the unit to the agent, an agent will sell the goods. It is known as consignment sales. We have already read that in your previous classes. What is consignment sale? In consignment accounting, consignment sales, what will be done? Goods will be shipped to an agent. Okay, it is called as consignment. Okay, an agent, that is consignee, will sell the goods and send the remittance to the seller periodically. So here three parties will be there in consignment sale. Consigner will be there, who will send the goods to the consignee, that is the agent. An agent will be responsible for selling the goods to the customers. Clear? And a consignment agent will collect and send the amount to the consigner after deducting his commission. Okay. Then another concept you can understand in receivable management is bills of exchange. That is bills receivable. Okay. Sometimes what may happen that sale will be done and seller will accept the bills receivable instead of cash. Seller will say that give me bills receivable. Okay, so in that case debtors will not be there, bills receivable will be your receivables. Okay, so bills receivable is a form of receivable only, but we know that bills receivable, there are various advantages. No, you can discount the bills in a bank and get the money earlier. Okay, these are all the advantages of accepting a bills receivable. That is known as bills of exchange. Okay. See what is the, now let us understand what is a credit policy. In credit policy, there are four things you have to understand in a credit policy. First, let us understand what is a policy. Policy is a general statement which is made by the top management regarding any activity in the business. Okay, policy means what? Statement which is framed by top management of a company. Okay, it is known as policy. There will be various policies which should be followed by other employees of the company. Okay, always policy statement will come from the top management. They will frame policies for different activities so that there is smooth functioning of the business activity. Like information technology policy, IT policy, in that all the matters related to IT will be there. So in credit policy is there, where credit management policy will be there properly. Okay, like that various policies will be there, purchase policy, etc. So policies are statements which are framed by the top management of the company, which every other employee should follow. That is a very important thing you have to always understand. Okay, likewise in credit policy, what all things will be there, aspects will be there. Let us understand. One is the credit standard. What is a credit standard? Credit standard means the standard which should be applied for sanctioning the credit. So what is the standard a company has set before sanctioning the credit? Okay, what should be the standard limit applied before sanctioning the credit? So there can be two types of view. One will be liberal credit to the customer. So you can call it as liberal credit standard. Okay, one advantage of having a liberal credit standard is that it will push up your sales. So standard means what? Some base, okay, which has to be predetermined. So that is known as a standard. Okay, in standard costing you study standard cost. So it is a predetermined expectation. It should be the standard. Okay, likewise, before deciding on the credit, it is important to ask a question: what should be the standard for sanctioning the credit? It can be liberal standard. Liberal credit standard advantage is that it will push up the sales. Okay, one thing, but everything will have an opposite view also. No, if sales will increase, there will be also higher incidence of bad debts also. Okay, because you are liberally giving credit to anybody without checking the historical behavior of that purchaser, etc. Okay, whether he has defaulted in past or not, whether he is having a repaying capacity or not, whether he will give the timely repayment or not. All these things you're not checking and giving liberal credit to everybody. Okay, even to new customers also you are also giving. So advantage is that it will push up the sales, but that is not the sole motive. No? You should collect the money also. No? So liberal credit standard will push up the sale, but on the other side of the coin, it will be having a higher incidence of bad debts also. Okay. Then large investment account receivable will lead to blockage of funds and higher cost, because you will have to take the overdraft from the bank. So this all will be the disadvantage of the liberal credit standard. Okay. But Other extreme side will be stiff credit standard. So if your company is having a strict credit standard, give credit to very selected persons only, it will have an opposite effect. Sales will be less, but all other things will also be less. That is the lower incidence of bad debts. Your investment will be not blocked. So you will not be required to take the overdraft facility. Your collection cost will be less. Okay. So there are two extreme. One is the liberal standard, you can say, and another is the stiff standard. So between these two, we can say that it is normally followed by all the business. So any business will not give liberal credit to everybody. Okay. And at the same time, it cannot give a stiff credit standard also. So whatever policy will be there, it will be median way between the liberal and the stiff standard. So this should be decided in the policy statement. What is your credit standard? Okay, you can select anyway that 50% you should pay in cash, 50% you can give in credit. So this will be a good approach. So like that, depending upon business to business, how much risk they are willing to take, based on their capacity, they can determine their credit standard. So that should be first decided by every organization. Second is a credit period. Now you have decided the credit standard. Suppose 70% cash, 30% credit. That is the decided by you. Now you should determine the credit period. That is how much days you can give for credit. So that is known as credit period. Okay. So credit period is means what? Length of time customers are allowed to pay for their purchase. Suppose 15 days time you are giving means customer will purchase, he can pay till 15 days. Whatever amount of credit you are giving, that he can pay within that credit period. So it may vary from firm to firm depending upon their policy. So firm that does not give credit is known as zero. Credit period will be zero. Okay. You cannot give longer credit period because again disadvantage will be there. There will be blockage of funds and higher incidence of bad debts will be there. Okay. So this is the next thing which you have to see is the credit period. Then cash discount, which we have already discussed. Cash discount is a discount which is given to the customer to induce or encourage them to make prompt payment. So cash discount, see 5/10 net 45 means you can pay within 45 days. But if you are paying within 10 days, you will get 5% discount. Okay. Suppose 1 lakh is the price. You can pay this 1 lakh within 45 days. That is the normal credit period given to everybody. But if you are paying within 10 days, we will give you 5% discount. Okay. So you pay only 95,000. If you are paying within 10 days. So this is the concept of cash discount. You will get 5% discount for making early payment. Then all the things you have decided, credit standard you have decided, credit period you have decided, and cash discount policy also you have decided, and you have decided to give on the credit. Now next, post credit will be collection efforts. So now you have given on credit. Now you should take proper efforts now to monitor the receivables. So you should constantly monitor your data. Send them letters timely. If it is overdue the credit period, you should send them letters, reminders. Okay, whose due date is approaching fast. Now say 45 days, if anybody is giving credit, so debtors may not have the remembrance, no, that 45 days before I have taken some goods, because they will also be busy in their daily schedule. So you should take effort to send them letters that 5 days before, 10 days before, that your due date is approaching fast. Please repay the amount or pay the amount. Okay, you can do telephone, you can approach them through telephone. Okay, in extreme case, if some debtors are not paid, 45 days time you have given, but 100 days has lapsed, till now no payment is coming. So what will be the last option? Threat of legal action. We should give them a strict notice that we will take legal action. Okay, in that also customer is not paying the amount, then last option will be go for the legal action. So these are the collection effort, and this collection effort will involve cost, various costs will be there. If you're sending letters, etc., then various miscellaneous costs will be there, printing paper, etc. Okay, then you have to appoint separate persons for collection, so you will have to pay them salary, etc. Okay, and if bad debts is there, if you are going for legal action, then cost will be very high, because you will have to pay to the legal experts, advocates, lawyers, etc., for taking advice, for filing a case, etc. So all these collection efforts will involve a cost. So this is the credit policy. It will encompass 4 things, starting from setting the credit standard till collection effort and collecting the money. Clear everybody this much? Any confusion till now? Yes or no? Everybody comfortable? Comfortable? Yeah. Okay. Now next is evaluating the credit, that we have already understood now, and we will practical solution problems will be based on credit evaluation. Evaluating the credit policy. See, credit standard means credit standard means what standard you are applying for sanctioning the credit. Okay, you will apply some standard, no, before giving the credit. Okay, like what you will have some parameters, no, that to whom you have to give credit. Okay, you will have some characteristic, that a person who is buying our regular customer for at least 3 years, you will give the credit. So all this thing will come under standard. So everybody you cannot give credit, no. Suppose a customer has approached, come to your business for the first time, so you cannot give them credit. If you are giving, so it will come under liberal standard. These are the 2 extreme things, liberal and the stiff. Everything will lie between this liberal and stiff only. Okay, there will be some flexibility in the credits sanctioning. That is to whom you have to sanction credit, and what are the parameters you have fixed for sanctioning the credit. Okay, that is a very important. And you can decide the ratio also, that suppose if a person is purchasing 10 lakh rupees goods, so entire 10 lakh you cannot give on credit, no? So here you have to decide the standard, what will be the standard of credit and what will be the standard portion of the cash payment. Understood? You can say that 70% on credit or 30% on cash, or it can be opposite way also, or you can say 50-50. Okay, this is the credit, you can say, which should be determined in the policy credit standard. Understood? See, here you will understand it. Credit evaluation. You should properly assess the credit risk. In traditional approach, say, to credit analysis, credit manager assess the 5 C's of the credit. So before giving credit, no, you should see 5 C's of the credit. First is the character of that debtor person, whether he is willing to pay the debt. So it shows the integrity and moral attitude of the customer. So how you can come to know the character of the customer? By looking his past data. No? So this first thing you have to see. So for that purpose only we have said that credit standard you should determine properly that to whom to you should give credit. So for that you should look these 5 things. First you should see the character of that person, whether he will pay the debt amount properly. So for that you should see the integrity and moral attitude of the customer. So this you will come to know from his past approach. So that's why a new customer who will come to your business, you will initially reluctant to give him credit. Okay. Normally you give credit to your old customer and good customers. Then second thing you should check is the capacity. Whether if you are giving the person credit, whether he will repay the amount or not. Capacity you should see. Then you should see the capital, that is the financial strength of the applicant. This is the second thing. Then next is collateral, whether he is giving some security or not for the credit. If credit amount is very high, okay, sometimes big dealers sell goods worth rupees crores and lakhs, 50 lakhs, 1 crore. So everything cannot be given on credit, no, without taking any security. So this all will come in the standards. Then condition. We will put some conditions, no, before giving on credit. You will sign some agreement, etc. That condition, all these 5 things you have to check before giving a credit. So this you can also understand it as standard also. What standard you are setting before giving the credit. Okay. Now I think everybody should be clear. Character you should check. This is a qualitative aspect which you will come to know from the past behavior of the customer. Then capacity, capital, collateral, and condition, these are all quantitative aspects. Capacity and capital you can come to know by reading the financial statements of the customer, etc. Whether his capacity is there or not, whether he's having the financial strength. Okay. And collateral, you can recommend the customer to keep some security before sanctioning credit. And you can put some condition or agreement before making the deal. Okay, so this much everybody comfortable? Any confusion? See, again, they have beautifully explained. See, from where you will get this information, financial statements. Okay, then bank references. You can take reference from bank also. Then past experience. Okay, then credit bureaus. Various agencies are there which will give credit rating to the customers. Okay, if there is any default in past, then their credit rating will be bad. Okay, unfavorable. So all these things you can get the information. Understood? See, first main source is the financial statement of the customer. There you will come to know about the capacity, capital, solvency, status of the customer. Then you can take the information from the customer's bank. Okay, normally sometimes banks also give letter of credit, etc., in favor of their customer. That can be one thing. Then experience of the firm based on past dealing with the customers. This thing you can check. Then trade checking. You can confirm from your business friends, business circle. Okay, another firm about the experience. Okay, so you can always check in your business circle, trade circle about the customer before giving huge credits. Okay, and credit bureaus, they are the, you can say, like an organization from whom you can get the information about the customers. Okay, normally in advanced countries, credit bureaus are available. Okay, they can consolidate the information and give it to the seller about the customers. So normally these are all the popular things you can say. You can take the financial statement of the customer. You can take the letter of credit, bank reference from the customer's bank. Then past experience also you can use. And most important is you can check from your trade circles, business friends, etc., about the customer. Okay, normally huge amount of credit is given. No? If you will take the example of dealers, etc., they will sell goods worth rupees crores and lakhs. So before giving credit, you should take the proper things. Otherwise, there will be risk of default. Okay. See, once credit worthiness of the customer is assessed, once you are satisfied everything, you have checked everything, 5 C's you have checked of the customer, then you are finally decided to give the credit to the customer. Then manager can take 2 decisions. What will be that decision? First, there will be request for the credit from the customer. Once credit request come, you have to see the 5 C's of the customer, then your company's policy, everything you have to check, everything you have assessed. Then finally you can take 2 decisions. Either you can offer the credit. If your company policy is allowing you to offer the credit, you can offer the credit, or you can refuse the credit also. You are not satisfied with the customer's profile. Okay, 5 C's, you find that there is some issues in the customer, you can refuse the credit and straightway say no. Suppose if you offer credit, then there can be 2 possibility again. Customer will pay the amount, then there will be revenue minus cost. This will be net benefit. Or if there is default by the customer, then there will be complete loss, that is cost. So this can be the situation if you decide to give credit. Understood? So this much everybody understood, I am assuming. So now from the next class, we will start the practical solution on how to evaluate the credit policies. So in the previous 2 classes, today's and previous class, we have understood the concept of credit management. I am assuming you have noted it down also in your notebook.